Half an hour into the start of U.S. trading, let's get you a check on the markets. Taking a look here at the major averages, all in the red here, but the S&P 500 is off about 0.75%. You've got your tech-heavy NASDAQ off about 0.6% here. Interesting to see what's moving in the Mag 7. You've got NVIDIA and Meta firmly to the upside, both up over 1%. You've also got Broadcom up right now ahead of its earnings that we mentioned later this week. Apple is also up. Having said that, we've got Google, Alphabet, and Tesla also in the red amid the Mag 7 this morning. But let's flip the board over to the bond market here, taking a look at yields inching up just a bit here. You've got your 10-year up about 3 basis points. You've got your 30-year yield up about 4 basis points at the moment as well. And finally here, taking a look at Bitcoin, it is down about 0.4%, still above that 103,000 level here. I do want to mention quickly before I move off of my markets check here, the ISM manufacturing data falling to 48.5 after 48.7. The median estimate was 49.5, so that is again below that estimate. We did see production and new orders rising just a touch here. Imports, however, fell to the lowest reading in 16 years. New export orders also fell to the lowest in 5 years, so perhaps a little bit of a fall off the back of an increase in purchases ahead of any trade issues that companies were anticipating here. Also seeing employment rising to 46.8 versus 46.5, potentially an indicator to look at ahead of that key jobs report coming in later this week. So again, that headline number coming in at 48.5 after 48.7 for ISM. Well, I do want to finally bring my co-host for the hour, Jay Woods, Freedom Capital Markets Chief Global Strategist. Jay, great to speak with you this morning.
Great to be back.
Thank you for being here with me. Talk to me about what you're seeing. I mean, I just read through some of the ISM manufacturing data here, falling just a clip. But what does it signal to you that every single data point that we are getting in feels so important right now?
It really does, because sentiment had been so bad for so long. So we're finally digesting some hard data. Well, is the sentiment justified? Is it going to be as bad as people think it was? And we're seeing some contraction with those ISM numbers under 50. It was expected. I don't think it was off that much where it's going to cause much fear in this market. We're still more concerned about anything that comes out of Washington on the tariff front than, the hard data. But that hard data is impacted by tariffs, and we have yet to see them really have that impact. I think the jobs numbers at the end of the week, not just the unemployment number, but the jobless claims, that ticked up surprisingly last week. If we get above 250, that to me would be a little head scratching. We haven't seen it get above 250 except for 2 times in the last 18 months, and that was due to hurricanes and a Boeing strike and a GM strike. There's nothing that will kind of say, all right, this is justified now, but continuing claims have hit highs since 2021. So the hard data on the jobs front, I think, may be the story by the end of the week, but we'll continue to look at tariffs until then.
Well, it's all about the tariffs, but what's fascinating when you look at the S&P is that we're under 4% away from all-time highs now because of the run-up that we had in May. So does that, to me, it feels like the market has just said, okay, tariffs are over. How big of an issue is that if tariffs are not over?
Well, the S&P 500 is up for the year. This is insane. If you told us that we were going to have all this threat and no resolution to these threats and we were going to be flat, I would have taken that any single time. So we're not out of the woods. We still, we're so close to those highs, but what's the catalyst to get us to new highs? We had NVIDIA earnings last week. To me, that is the leader when you look at the Mag 7. That is a stock that led us from the bear market in 2022 to new highs. It was the first of the Mag 7 to get there. Microsoft was on the doorstep to new highs. Didn't get there. NVIDIA, it rallied, it faded after some solid earnings. So I think we still need a little more time, and that time will, could be a slow summer, but once again, whim of Washington. Let's see what happens on these tariff deals. We get a few deals in place. We were supposed to have 90 deals in 90 days. We have one with Britain, and I don't even know. It was a little wonky.
The concept of a deal.
The concept, everything's pushed back another 2 weeks. We'll see where this goes, but we're trading on hope, and then we can dig into it later, but this taco trade could have some impact on the market because if the president seemed a little annoyed by Trump always chickens out, if he puts his fist down and says, no, we're going through with these tariffs. We're seeing it in the steel tariffs against the EU right now. EU is going to push back. China and the U.S. are pushing back. We'll talk about that in the hour. So there's still so much uncertainty, word of the year, that some of this good news and some of this sentiment, I get the sentiment, but the hard data isn't really following through yet, but we're seeing some cracks. The ISM is one of those cracks.
Yeah, and there's so much uncertainty, but to your exact point, the leadership looks the same as it did when we came into this year. Can big tech, can NVIDIA continue to bear the weight of the entire market on its shoulders for the rest of this year?
Yeah, well, it rebounded. So we got back to levels. 4 of the 7 in the Mag 7 are up, 3 are down. So we're getting there, but it's not a tide lifts all boats scenario. And we have sectors, the industrial sector is the leading sector. No one talks about the industrials. That is actually a good sign of diversification and strength in the U.S. economy. We're still not seeing that hiring, but wages still remain at good levels. So there are just so many mixed signals that we are waiting for something to deflect. Jerome Powell will speak later today. Maybe he touches on that. But someone that was going one data point at a time, the data points have been good. It's the sentiment, it's the unknown that has us on edge. But the longer we go out into the year, we're halfway through now. We're in June. The Fed could cut if those jobs numbers do tick up a little bit and, inflation remains as stable as it is. The PCE number came right in line. We're not at 2%, but we're at a nice level historically. So this bodes well for at least the Fed narrative to say, okay, maybe a cut can be on the table.
Maybe a cut's on the table. Maybe the sentiment doesn't turn into a spending problem, and maybe it's all fine at the end of this year. Jay, you're going to stick with us to make sure we are fine throughout the hour, so thank you. Appreciate it. Let's move on here. U.S.-China tensions heating up as China pushes back against President Trump's claim that the country violated its side of the trade agreement and instead accusing the U.S. of violating its trade terms. Joining us now for more on the outlook for negotiations, we've got Tim Brightbill, Wiley Ryan partner. Tim, great to speak with you this morning. Talk to me about this tit for tat between the U.S. and China both accusing each other of the same thing. Is there any merit to that? Is this just negotiation and the art of the deal? Where does this sit with you?
Thanks for having me this morning, Madison. I think there are things going on both sides here. The United States and China both have some accurate statements that they've made. The Trump administration is clearly frustrated with China, that it's not living up to the May 12th agreement, and in particular, that it's slowing down access to rare earth magnets and other critical minerals, which are needed for so many different segments of manufacturing. Now, MOFCOM, of course, has pushed back and said that it's the United States that is escalating the situation, first with restrictions on the sale of chip design software to China, and then also some of the other issues, such as the announcement to revoke visas of Chinese students. So I think both sides make some valid claims. It's mostly negotiations, but we do want to see these discussions move forward, given the size of the tariffs that have been suspended between the two countries.
And talk to me about what that looks like. What would be the impetus to make these negotiations move forward? Are you seeing any signals of further discussions happening?
I think both sides are very interested. So yes, I think there are signals of more discussions. There will be other opportunities going on. There is an OECD meeting this week. This is a high priority for the administration, for Ambassador Greer, but there's a lot of ground to cover and a lot of very hot button issues between the two countries. So not clear how quickly it will be resolved.
And David Sachs over the weekend talking on his podcast about how it would be great if the entire world had to rely on the U.S. tech stack going forward here. But the problem with that is that would require less restrictions on China. So which is it from this administration? Do they want the entire world relying on U.S. tech, which would of course be good for NVIDIA, or do they want restrictions on China that would disallow that from happening?
I think so far the restrictions on China are a higher priority. I think there's just great concern that the export controls and other limitations, licensing requirements put in place over the years have not been sufficient to stop China's rise in these areas, whether it's semiconductors and other sectors. So I think the restrictions are going to play a key role going forward. And somehow the two countries are going to have to reach an agreement even with those restrictions in place.
And my guest host, Jay Woods, has a question for you, Tim.
Hey, Tim. Speaking of reaching an agreement, we have two big egos battling. What do you think it's going to take for them to both declare a victory and to come out looking good? Because right now, the rhetoric is really starting to heat up, and the more it heats up, I think the more damage it could do to the markets.
I think that's exactly right. What's at stake, though, are these huge tariffs up to 145% before cooler heads prevailed and those tariff increases were suspended for 90 days. I think both sides understand that it's in their interest to not have those sky-high tariffs take effect, but there are an awful lot of issues on the table to be resolved between now and then. And it's going to take some movement from both sides likely before something moves forward. I mean, China is a different country from where it was during the first Trump administration. It is going to play hardball. The United States is ready for that. But it's going to take some movement by both in order for a deal to occur, I think.
And Tim, speaking specifically about NVIDIA, are they able to work around the current legislation in terms of chip curbs to be able to access what CEO Jensen Huang calls that $50 billion market in China? Or are these restrictions so intense that they will not be able to do that?
That's somewhat unclear. I think the restrictions are much more comprehensive than they have been. But at the same time, we get reports that some companies are still able to do what they need to do. So it's unclear. I think the administration is trying to tighten these up as much as possible. It doesn't want to cede growth to China, especially in these high-end semiconductors. Yeah. But it's not clear whether they're effective or not.
And Jay, I want to bring you in here. If NVIDIA can't access the Chinese AI market, how big of a headwind would that be for them going forward?
They've navigated it well. They took that $8 billion charge just last quarter. Jensen will find a way, but this is not the way ideally he will. The growth will still be tremendous. The spend continues to be big on CapEx from the Mag 7 stocks that use its product all the time. But this would make the road for this stock to break out and go another nice leg higher much easier.
All right, Jay, thank you so much. And a huge thanks to Tim Brightbill for joining us this morning as well, Tim. Really appreciate it.
Thank you.
We're going to have all your markets action ahead here at Yahoo Finance, so stick around. You're watching Catalysts.
The S&P 500 just clocked its best May in 35 years, but what happens next? I'm Jared Blickery, host of Stocks in Translation. Now, May was a market blockbuster, up just over 6%, the best showing since 1990, the second best since 1948. The historic post-Liberation Day sell-off, it felt like a bear market, but it set the stage for the huge rebound we saw. And guess what? Nevertheless, before you get too comfortable here, let's see what history says about the next moves. In the chart behind me, we're focusing on June alone. Historically, when May is this strong, June tends to keep the trend and momentum alive, at least modestly. The median return is a decent 0.6%, and that is double the long-term June average, going all the way back to 1928, and much better than the tiny median move we've seen since 1990. Not a home run, but enough to suggest that a strong May is typically not a flash in the pan. Now, zooming out month by month, here's where it gets really interesting. July usually extends the party, posting a solid gain that is a full percentage point above normal, measured again since 1928 and 1990. But watch for a possible autumn shock. The historically volatile months of both September and October often deliver a reality check, with October specifically shaking out weak hands and below average returns. Here's the good news though. November tends to be the real fireworks show, historically posting a big 3.8% median gain, over double its usual performance. Let's bring it home now with the longer view. From June through December, the S&P median return after these strong Mays is nearly 11%, and that is significantly higher than the longer-term average since, again, both 1928 and 1990. If we stretch that out, if we stretch that window through the following May, the gains climb above 15%, a substantial premium over typical years. So what does this mean? Markets post-pandemic, they seem to be speeding up, moving faster and faster. Volatility hits harder, but patience is paying off. So yes, we have rates potentially above 5% on the 30-year, escalating tariff tensions, and both of these could create speed bumps. But remember, this rally is still unloved and under-owned. That means even small doses of good news, better earnings, a friendlier Fed, cooling inflation, all of it could quickly reignite the spark. Bottom line, after a blockbuster May, history says, with a few caveats, stick around, it could get even better. And tune into Stocks in Translation for more jargon-busting deep dives and new episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Jared, thank you so much. It's now time for some of today's trending tickers. We are watching D-Wave, DJT, Meta, and NVIDIA. First up, D-Wave and DJT, bought by the second largest public pension in the United States, the California State Teachers Retirement System, increasing holdings in the first quarter, disclosed in an SEC filing. Jay Wood's still here with us for more. Jay, 211,000 shares of D-Wave, 21,000 of Trump Media here. Interesting timing given the strong outperformance of D-Wave in their first quarter earnings print.
Yeah, these quantum stocks remain a retail darling, but now you're seeing big institutional investors take a shot on this. And I was just looking this up. D-Wave, 500% year-over-year increase in revenue.
Huge.
The stock is up 1,000%, 1,072 to be exact, in the last 52 weeks. So it's pulled back. It's lost some of its recent momentum. It's actually down over the last month. But these are names that continue to grow on a revenue stream, and they may be attractive to some of the bigger players that may be missing out. Some of those Mag 7 names looking to scoop one of these names on the cheap. So for me, when you look at some of these quantum names, yes, the RGTI, the Rigetti, the IONQs, they tend to be extremely volatile, great day trading tools. But if you look at how they're growing, it's starting to stabilize, starting to normalize, and it's opening the eyes of not just retail, but some of these institutional investors like California's pension fund.
And
Crazy.
this is why it's so important to look at how these pension funds are investing once we do get that information through the 13F filings, a little bit of that institutional buy-in there. But next up, let's talk about Meta, aiming to fully automate advertising with AI by 2026. That's according to a report from the Wall Street Journal. The goal, to allow brands to fully create and target advertisements with Meta's AI tools. It's part of CEO Mark Zuckerberg's vision for the company's future. You can see those shares up nearly 1%, up about 0.8% here, but really interesting to continue to see this evidence trickling in of how AI is going to make companies more profitable when it comes to the bottom line.
Well, Mark Zuckerberg has been doing this for ages, and he continues to improve the technology. You and I, we're on Instagram, we scroll. The way they just target these ads, the way they just draw you in, it's unbelievable. And now, from a cost-saving point of view, AI is going to take away some of the jobs that they have at Meta. Is this a game changer for them? No, but we're up 1%. Meta still has another 90 points to go before it's at all-time highs, but this is progress. And when you talk Meta, that's all they continue to do is improve upon their technology. CapEx spending continues to be one of their biggest, drawbacks for those looking for them to, save a little bit of money. Yeah. But overall, this fits right into the narrative of what Facebook has been doing. Continue to automate, grab eyeballs, grab attention, and this should be a good thing for their bottom line going forward.
Also interesting in terms of labor market impact. We had the CEO of Anthropic last week saying that you could see an increase in unemployment over the next 1 to 5 years of 10 to 20% due to AI, and certainly that could happen with Meta after this news. But finally, let's take a look at NVIDIA, the chip maker, reporting an upbeat forecast in its most recent earnings report. Jay, I know that we've been talking about NVIDIA throughout the morning here. Yeah. How are you thinking about this stock? Can it continue to be this sort of outperformer chip giant that it has cemented itself as, or is the slowing of earnings growth something that you're concerned about?
Well, you're slowing to an amazing level that anyone could dream of having. No, when I look at this, I look at the historical price action. When you see the stock trade, it has a tremendous run, a lot of momentum. It's lost that momentum. I think earnings day was perfect. It opened at 143. right off the highs and then slowly trended lower. It's digesting. It's still above all key moving averages, but it's going to take time, another catalyst to get it going. Today's news is just positive news, but we're waiting on, like the last segment, China tensions to ease, tariffs, certainty. Once Jensen figures that out, then watch out, because the spend is still there. The technology is still second to nobody. And to me, it's just getting ready to take that next leg higher. We got to see what that catalyst is. It's probably another quarter. So the stock has been going sideways for a year. That's not a bad thing, and we're making higher lows now. So I think it's getting ready to explode, say, summertime, end of summer. But right now, sideways action is fine. This is still one of our leaders, just not ready to lead yet.
Yeah, and we were talking earlier about how the company is expected to lose billions in revenue due to those H20 chip licensing requirements. But you talked about how they'd taken it on the chin, and then moving forward here, we do have some reporting that they're working on a new AI chip that would meet any restrictions coming forward for the administration. Does NVIDIA have to continue to do that to survive? Like, do they have to sell?
They don't have to, but if you want to see the exponential growth as an investor, as a shareholder, that's what you want to see. So when that next rollout of a chip and it doesn't have those restrictions, where it's basically tethered to the ground or tethered in this neutral range, then the stock is going to explode. So we're one Jensen event away, one new chip rollout away from a breakout, or we wait a little while they work on things, and then we get certainty from Washington. Trust me, when this market does make new highs, I'm pretty sure NVIDIA is going to be trading above 150, leading the way.
All right, you heard it here first, folks, from Jay Woods himself. Jay, thank you so much. As always, for our audience, you can scan the QR code below, where you can track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, we're going to dive deeper into those May ISM manufacturing numbers for Reed on how trade policy is weighing on the sector more broadly. Stick around. You're watching Catalysts. Taking a look at ISM manufacturing data for May, PMI coming in at 48.5, representing the third consecutive month of contraction. The number declining slightly compared to April's 48.7 reading. Here to break down the full report, we've got Susan Spence, ISM Manufacturing Business Survey Committee Chair. Susan, great to speak with you this morning. Talk to me about your takeaway here, just a little bit of a contraction in this headline number.
Sure thing. Thank you. And thanks for having me on. I do appreciate it. Not surprisingly, we've dropped another 0.2 percentage points. The analysis we're doing is seeing a continued weakening of demand. Backlog, new export orders, which were down about 3 percentage points. New orders down. Not a surprise. Customer inventory, the other piece of demand, still pretty low, and we think that's positive. Customers have to reorder at some point. But really, for the 6 months, the biggest concern with the panelists remains tariffs. 86% of our panelists mentioned that in their headline comments. The sentiment this month, for every positive comment, there were over 5 negative comments about the tariffs. You could read it in the report. People are worried. I'm seeing comments comparing it to COVID, saying it's worse. And having lived through that as a procurement executive, didn't think I would see that at some point. So they remain those concerns. Production and employment had a little bit slower contraction, but it is certainly still contracting. So we continue to see layoffs happening. We have a hiring versus what we call force manage. For every person hiring, there's 1.5. That's worse than last month. People that are not replacing folks are laying off.
Well, no, Susan, I wanted to follow up on that, because that's really interesting, because the employment number to me looked like a potential bright spot, a silver lining within the report. But then I hear you saying perhaps when you look even more under the hood, it's not. Talk to me about the takeaway from this month's data on employment specifically.
Sure. So, it's difficult, but we know companies need to look at their cost structure. And if that demand is not coming in and production is low, they need to do something. Rather attrition, not backfill someone, than have to lay somebody off. The fact is both are happening, and layoffs are happening at a greater rate than the other two. So with the uncertainty, at least my experience in almost 38 years in the business world is with uncertainty, you do not hire people because you don't want to have to turn around and let them go. So there's price uncertainty, there's supply uncertainty. Suppliers are taking longer to deliver their product. We think that's still a hangover from port congestion, but it's also likely due to not understanding who's going to pay for tariffs and wondering if they're even going to happen.
And Susan, my guest host Jay Woods has a question for you.
Hey, Susan. Do seasonal factors come into play here as well as we go into the summer season? We've gotten through the Christmas holiday season. Cold winter, I know, had an impact on things. What are the next seasonal factors you're looking for that could get this number to uptick back above 50, perhaps?
We have, of course, the seasonal, non-seasonal. We have an index for that so that we can normalize it. I believe this is beyond the normal. It's the production numbers are down. There's certain industries that should be up by now. There's just not enough of the industries that are entering growth territory. And if you look at the overall sub-indexes, especially around demand, pardon me. And then the inputs are another story. The supplier deliveries continue to take longer. In great times, that means that they're so flush with work that they just have a hard time getting their product out. We don't believe that's the case. The inventory number on the input side was interesting to me too. So that is in contraction this month. That makes sense to me because if you're not getting a whole lot of new orders and you're getting even less new export orders, your backlog is burning down and your inventory is starting to deplete. That kind of makes sense to us. And also the import, you saw that import number. It dropped 7.2 percentage points in 1 month. The number this month is the lowest reading since May of 2009, 16 years ago, right? So that is worrisome, yet it makes sense given what's going on. And prices, of course, remain high. The increases slowed down a bit. So there's seasonality, but this is a very different time. And I pay a lot of attention to what these purchasing managers across 18 industries are saying. And having lived through that myself over 38 years, I get their pain. So the only thing that can help is certainty, and whatever is going to finally be happening with the individual countries, let's please get on with that and get some certainty here so that customers place orders, that backlog can grow, stop laying off people, replace those that have left, and kind of return to health.
Susan, really appreciate you joining us this morning. Thank you so much.
Thank you.
We're
Appreciate
going to
it.
have all your markets action ahead here at Yahoo Finance. So stick around. You're watching Catalyst. Moderna shares moving to the upside today. The FDA granting the company limited approval for its lower dose COVID-19 vaccine. This coming as the pharmaceutical industry has been under pressure, facing a fractured relationship with HHS head RFK Jr., as well as tariff policy risks more broadly. Our next guest names two key areas of opportunity for investors in the healthcare space. Joining us now, Jason Kreitzer, Morgan Stanley Investment Management Portfolio Manager. Jason, great to speak with you this morning. Obviously, as we mentioned, a lot of headwinds for the pharmaceutical industry. What is giving you some optimism about how pharma stocks could do in the second half of the year right now?
Sure. Well, we're trying to focus on areas where there's less attention that the administration has. Medical devices and animal health are two areas that really are kind of avoiding a lot of the spotlight from an administration perspective. If you look at healthcare, it's been very, very volatile this year. Bottom of the leaderboard in terms of performance from the S&P sector perspective. So trying to find areas where there are opportunities. On the medical device side, we really like Intuitive Surgical. This is a robotic surgery company. This is a very cool company. That it's very innovative in terms of its design of its new products, which are helping surgeons basically become better at their job. The addressable market for this Da Vinci 5, this is their new robot. It's had about 8 million global procedures, and this is in urology, general surgery, gynecology. The company's procedure growth is in the 13 to 16% range. That's volume growth. We don't really see that kind of growth in healthcare, and so this has been a terrific long-term compounder. in the other areas, we really like animal health. Zoetis is a leader in the both companion animal, which is pet, and livestock space. For the last 10 years, Zoetis has grown above market, and that has been a core to that thesis. Really, has been their innovation. They're very large in pain, in flea and tick, and also in dermatology. Pain is more recently. There are 27 million dogs under the care of vets in the U.S. that have osteoarthritis, and their pain medicine is really just scratching the surface. They've only attributed sales in that space to about 1 million dogs.
Yeah.
There've been a lot of questions in the market about drug pricing in human health. Keep in mind, there's no Medicare, there's no doggy Medicare. So from that perspective, we like animal health.
Yeah, I thought that was a really interesting framework, Jason. Is animal health investing a way to be Washington-proofing your health portfolio right now?
We think so. I mean, really, if you look at, it's a cash pay market. As I mentioned, no Medicare. As we all know, people love their pets and will be willing to spend a lot on their pets sort of out of pocket. And so while no sector is completely immune to economic uncertainties, the pet market is one that's, very exciting.
And my guest host, Jay Woods, has a question for you, Jason.
Hey, Jason, I think you're onto something big there. The ETF PAWS, P-A-W-Z, is a conglomerate of all those stocks. And you mentioned Zoetis. You may have already answered most of this question, but why does that stand out? Because there are other options within the pet insurance sector. Was it the livestock side of it? What was the thing that stuck out the most to you about Zoetis?
Well, if you think about Zoetis was a spin about 12 years ago out of Pfizer, and their roots are really on the innovation side, on the animal health, rather than on the livestock. They are a leader in livestock, and so their innovation engine is really what's attractive. They are coming out with new medicines for pets that have great outcomes, and that is really fueling their growth. And they're an above market grower, which has made it attractive to us.
Jason, really appreciate your time this morning. Thank you so much.
Thank you.
Coming up here, finding opportunities within the AI space. We've got the investor playbook that you need to know next, right here on Catalysts. Broadcom set to report second quarter earnings on Thursday after the close, offering a closer look at the future of the AI boom. My next guest says markets will default back to AI after trade tensions subside. Joining me now, we got Paul Eidelman, Russell Investments Global Chief Investment Strategist. Great to speak with you this morning, Paul. So it's interesting. We've obviously seen a lot of market volatility. We've sort of done a roundabout right back to where we were at prior to the Liberation Day announcements from the president here. How do you anticipate AI playing into market leadership for the second half of this year as those trade tensions probably continue?
Well, we've just had so much noise and policy-driven volatility here over the last couple of months. And so if we can get beyond that, and obviously we have an important conversation potentially this week between Trump and Xi that could set the tone for trade policy going forward. But under the surface of that, AI is this big catalyst and potential secular growth opportunity could resurface as sort of the major driver for markets going forward if this policy backdrop can kind of tone down a little bit. And, the big tech names have really been strong performers. If you look back over the month of May, some of that is the trade tensions coming off the boil a little bit because they were seen by investors as potential retaliatory targets in an escalating trade war. But some of it as well, if you kind of look through this first quarter earnings season, on balance has been excellent. And the big tech companies have been strong performers in that theme. At the S&P 500 level, we're now tracking almost 15% earnings growth in the first quarter of this year, which is almost double where the consensus was coming into this period. And so that fundamental strength, that pickup in investor risk appetite as trade tensions have come off the boil a little bit, and this underlying secular growth opportunity, I think could potentially refocus investor attention in the months ahead back towards this sort of fundamental trajectory of U.S. tech and fundamentals again going forward.
And I wonder how you think about individual names. I know you can't talk specific stocks, but Broadcom is on my mind this week because earnings are coming up. And I wonder how you think about Broadcom's role within the broader AI trade and what that name sort of signifies and what is the kind of differentiating factor of a name like Broadcom within that broader AI trade.
Yeah, I mean, without touching on an individual name, I think there's been this early first wave in AI with a lot of focus on hardware and infrastructure build out. And that's been a very strong theme in trade for the better part of the last couple of years. And I'd say it continues to come through in earnings delivery based on the sort of basket of corporates that we have visibility into so far in the first quarter. As we kind of have conversations with our money managers on the opportunity set going forward, a lot of focus is on trying to access this theme at an attractive price. And so I'd say one of the narratives that we're kind of hearing in terms of value and the opportunity set going forward is potentially a transition away from the builders of AI to the users of AI going forward, and looking at, call it, other large corporates across the US ecosystem that have sort of large proprietary data sets that can leverage this technology for meaningful efficiency and productivity gains for their business models. And I think that sort of potentially large next step as adoption rates increase here in the months and years ahead is kind of the key focus area from our investors.
And Paul, my guest host Jay Woods has a question for you.
Hey, Paul. It seems like the beginning of this pause in the rally and the strength we've seen in some of these AI hardware names started with DeepSeek, then it went to tariffs, and we're slowly getting through that. But there are opportunities in software and then energy powering these stocks. Are there any areas that you think should continue to lead before we see that next leg up in the hardware space?
Yeah, I think software and utilities and data centers are maybe a nice middle ground for this theme before it potentially broadens out to the entire U.S. ecosystem. Software has been a focus and an area of interest for our money managers, both in terms of the ability to write compelling code much faster than previously was the case, but also leaning into this AI ecosystem and generating sort of new and compelling applications for it for the U.S. corporate sector is a key area of opportunity. And I'd say this data center and energy demand theme is probably more consensus, but as we listen to what the large tech company CEOs are saying on their earnings calls and their investor conferences recently, there still seems to be almost an insatiable appetite for compute. There's a lot of infrastructure build out to maintain and build upon these technological capabilities and their growing user base over time. And so that impulse onto energy demand, I think, is likely to have some staying power here and is starting to transform the utility sector within the equity market from in the old days being a little bit more like a bond play within the equity market to now having a little bit of a growth engine behind it and that generating some repricing in the market.
Yeah, that's really interesting, Paul. I do want to end on some of the headlines we've been getting out of Washington with regards to export controls specifically, and some reporting this morning indicating that China could be responsible for about 25% of the AI market. Can the AI trade continue to experience earnings growth without unfettered access to the Chinese market?
I think a number of areas of the market are going to be challenged if there's a sharp drop off in Chinese demand. It's not just tech, but a whole range of U.S. production and U.S. corporates have extensive exposure to China, both in terms of demand and demand growth. But yes, I think it is the case that China does have an important source of demand and appetite for U.S. technology products, and so a meaningful escalation and disappointment in terms of the trade negotiations with the U.S. and China would be, I think, a near-term headwind for this space. And so that makes this conversation between Trump and Xi potentially this week, we don't know exactly when, all the more important in terms of the near-term market dynamics going forward.
Paul, really appreciate it. Thank you so much. And a big thank you to Jay Woods, Freedom Capital Markets Chief Global Strategist, for joining me for the hour. Jay, always great insights.
Great to be here.
Thank you so much. Coming up here on Yahoo Finance, we've got Wealth. It's dedicated to all of your personal finance needs. Our very own Brad Smith is going to have you for the next hour, so stay tuned for more.